You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is self-storage expert Scott Krone. Now, Scott is a Chicago native whose career in architecture began in 1991 by pursuing his Master's of Architecture from Illinois Institute of Technology. In 2012, Scott co-founded SSSK Capital Fund, a firm who specializes in managing real estate assets. Since its inception, SSSK has managed a wide range of real estate, including single and multifamily homes, retail, commercial warehouse, self-storage, and multi-use flex athletic spaces. In 2018, SSSK Capital Fund was rebranded to Coda Management Group to complement his design-build firm, Coda Design Build. Scott founded Coda in 1998, and Coda Design Build is an international award-winning design and build firm which specializes in sustainable building practices. Now, some of Scott's more recent projects have consisted of adaptive reuse of vacant commercial buildings in highly desirable locations and converting them into self-storage facilities. This is actually going to be the primary topic of our conversation today. Now, as you guys are out there, whether you're driving your kids to church or to school, wherever you're going out shopping, in many areas of the country, you'll be able to find dark, different, buildings, grocery anchors, empty big box retailers, bowling alleys. The list goes on and on. Scott's going to show us how to identify these somewhat out of the box opportunities that others might not see any value in. He's going to show us how to add value and how he converts these into, again, self-storage facilities. And so, guys, with that, I'm very excited to get on to it with Scott. But before we do, I have a few quick housekeeping items I want to run through. First and foremost, if this is the first time that you're tuning into the show, just want to welcome you to our awesome family that we have here at the Real Estate Investing for Cashflow podcast. Or if you're one of the many tens of thousands or millions of listeners that tune in each and every month, I want to thank you for coming back and really making us a part of your weekly schedule. There's many other shows out there, and you obviously take the hour each and every week to listen to us. So for that, I'm entirely grateful. And since it's folks just like you that keep us going and give me this awesome hobby that I have here, I like to give a shout out to one listener a week that's taken the time to leave a review and rating on iTunes. And this week, this review is from screen name DeGrisa. Now, DeGrisa says, Kevin Bupp does it again with more solid content. This guy's a wealth of knowledge and so happy he's doing podcasts like this to share. So thank you so much for that. And folks, if you truly do love what we're doing here, if you love the guests that we bring on each and every week, then two things I'd love for you to do if you could. First and foremost, subscribe to the show. That makes sure that you do not miss any new episodes as they roll out. Okay. You want to be the first to listen to them, especially shows like this one here with Scott. You'll be the first to get them. In addition to that, again, if you love what we're doing, you love the shows, you like the content, you get value from it, you see your business growing because of it, please take a minute, go over to iTunes, leave a review and rating if you're so inclined. It literally does take like a minute, maybe 2 minutes at the most. For that, I'd be eternally grateful. It really is those reviews and ratings that help us grow the show and help us track awesome guests like Scott here. In addition to that, guys, I want to remind you of the free 30-minute phone consultation that I offer for folks just like you. There's no ulterior motive here at all. I'm not going to try to pitch you on a coaching or mentoring program or anything like that. It's just a way for me to connect with our listeners. I did this many, many years ago when I started this podcast. I did it for a couple of years and I went on a hiatus. Well, I reintroduced this program back into the equation a couple months back, and it's been absolutely awesome. I have 4 30-minute slots. I open up each and every Friday afternoon, and it's a way for me to help you during your real estate journey, whether you're brand new to the business, you've got some general questions, maybe a deal that you'd like me to act as a sounding board on, or even if you're a seasoned pro and you just want to talk shop and share some ideas, brainstorm, what have you. I'd love to connect with you. If you'd like to schedule that call with me, go to my website, kevinbupp.com, scroll about 3/4 of the way down. On the right-hand side, there's a button that says schedule a call with Kevin. All I ask that you do is when you're making that appointment, please be very specific about what you'd like to chat about during our time together. If it's a couple of questions, if it's a deal, give me the particulars, okay? 30 minutes goes by incredibly fast, and I have to stick to the time of our call, because I typically do the 4 back to back to back. Okay. So if you want to make the most of our time together, be very specific, put some notes while you're scheduling that appointment, and I'll be more than prepared when we get on the phone together. Guys, with that, I'd like to welcome our awesome guest here for today's show, Scott Krone. Scott, how you doing today, my friend?
I'm doing well. Thanks for having us, Kevin. I appreciate it.
Yeah, absolutely. I've been very much looking forward to this show. As you guys are aware, I've had many different self-storage folks on the show over the years, but none that take the unique approach that Scott and his firm take. And so that's really speaking to the adaptive reuse. He takes older buildings that had completely different uses, not self-storage originally, and converts them into a higher and better use, which is self-storage facilities. And so that's what we're going to be chatting about today. But before we get into the meat and potatoes, Scott, if you could, I gave you a brief introduction. Surely didn't do you justice there. So take a few minutes, if you could, tell our listeners a little bit more about yourself.
Well, thank you for that. It was a very kind introduction. I did begin my architectural career in 1991 with pursuing the Illinois Institute of Technology and the College of Architecture. And I was fortunate that one of my professors owned a development company. And so my master's thesis was a project that he was actually working on. It was a 50-acre site and over 400 condominiums and townhomes and single-family homes. And so that gave me the ability really to begin understanding the development side as well as looking at it from a design and construction point of view. So I was very blessed to be able to do all three working for him while pursuing my master's degree. So I worked for that firm for about 6 years. And as you said, in 98, we began Coda. And it was first converting single family homes. We tear down single family homes and build new ones and reposition them. So everything that we've done has always had an infill use. It's always been repurposing or reutilizing land because we're in a very dense community in the Chicagoland area. So there's not a lot of vacant land. And so we would always have to find properties and figure out what's a better and more appropriate use for the property. Mm-hmm. And so we did that with some single family homes, and we tore down some buildings and made some townhomes, and we did condominiums and mixed use and just a wide range of things. We also repositioned. The first repositioned buildings that we did were actually converting warehouses into churches. And so we did that for a client. And we've helped about 4 or 5 different churches now in terms of finding older facilities and repurposing them. And so, we haven't just done it within the self-storage area. We've also done it throughout the real estate. But it was after the crash that, the whole real estate market changed, and we really had to move out of the residential space. And we began buying distressed apartment buildings and looking at notes and other things along those lines. And that's when we got into the commercial realm. And we found an old building and we converted that into self-storage. And that's how we got into the process.
Very, very interesting. So there's so many questions that I have. Obviously, this is a completely different approach that we've taken in the past with prior guests to the show. And so I'm not sure exactly where we start. Again, got many questions here. And so maybe first and foremost, maybe let's just talk about that very first project, right? That's probably where a lot of the lessons were learned along the way, right? You made mistakes. So maybe speak to it from the very beginning, how you identified the opportunity of hey, this could have a much higher and better use, and ultimately it would be self-storage. In addition to that, the size of it, some of the challenges along the way, the demographics, and all the factors that were involved in you making the decision and then ultimately executing on that business plan.
Well, the first one, it wasn't really the intended use that we were going after originally. I was consulting and helping clients try to identify different assets to go after. And one of the clients wanted to go after self-storage and finding distressed self-storage. And in that market, in the recession, self-storage tends to do better than in a growth period. And so it was very difficult or almost impossible to find, quote unquote, a distressed self-storage for him to acquire. And the building was zoned for apartments and townhomes. And it was an old lock manufacturing and distribution facility. And right before the crash, the developer had rezoned it to apartments and townhomes. And then the market came and the bank pulled out of its financing. And so the project sat empty for about 3 years when we identified the property. So here was this big warehouse, 90,000 square foot warehouse that was intended to be condominiums, but there was no condominium marketplace. There was no townhome marketplace. Mm-hmm. And so we had a client that was interested in a portion of the building, and we had to go through the entitlements to convert it back into commercial. And the mayor originally gave us a nonverbal, but a head bob approval of support. And then about a month later, after we went hard on the contract, she changed her mind. And a mayor has that right to change her mind.
Typical fashion, right?
Exactly. But, we said, well, if we find something else, would you work with us? And she said, I'll do anything I can to make it happen. And that was a verbal confirmation as opposed to just a head nod. So I felt a little bit more confident in that. And so I called up my client and I said, you've been looking to get into self-storage. And I've been saying, like, the best way to make money in real estate is through the development process, because you can control the acquisition price. You can control a lot more from the front end rather than trying to work the numbers backwards. Mm-hmm. And so we have this building that might work. And so why don't you bring your team in and assess it and to see if this is the right location for you. So they did that, but it was through that process that I began learning the self-storage process and understanding what the demographics were that were necessary to support it, what were the cost structure. Mm-hmm. So when they went through the whole modeling, they said, well, we love the building, we'd like to do it, but we don't have anyone to build it for us. And so, we said, well, we can certainly facilitate that for you. So that is how I got into the whole model. And the client, that was their first one doing it, but he actually went back to mobile homes. He felt it was a shorter period of time frame, and it was a more simplistic model than self-storage, which to me is a more simplistic model of apartments. And so he went further down the continuum of cost structure and hasn't done another self-storage deal since then. And since that period of time, we've gone on to 6 other ones.
Wow. Very, very interesting. Okay. So that was an old, you said, lock factory. So very much like a urban infill type location, I would assume? Or
yes, it was. Mm-hmm.
Okay. 90,000 square foot shell. How many rentable units in that particular project were you able to squeeze out of that 90,000 square foot shell?
It was around 700. We didn't complete all of them. So the company that came in that bought it actually ended up adding more. In fact, they did both some exterior and interior. So they took it much further along than what we had originally intended. And so the final product was different than what we completed for them. But Compass Self-Storage actually ended up buying that facility.
Really? Wow. Very interesting. Was it a mixture of climate control and non-climate control?
It turned out to be that way, yes, because they had some outdoor non-climate control. But what we did was all climate control. And so originally we had 70,000 square feet of lockers. We had 20,000 of vacant that we were renting out while we were leasing it up. And they said that they wanted to buy the vacant area, and then they filled that portion up with lockers, and then they put lockers on the outside as well. Wow.
Fantastic. That's awesome. So basically, before you guys were even completed with the project, they came in and purchased it, which I'm sure they paid a pretty hefty price for it, knowing that they're a publicly traded company. And so I'd love to speak up maybe some of the other projects that you have as well. And more so from a standpoint of, now that during that first project, you were able to see some of the challenges, kind of refine the model a little bit, have a better understanding of what, now you might be looking for as far as finding a shell of a building that you could readapt into a self-storage use. So first and foremost, like, what are the demographics that you're seeking as far as, median incomes, home prices, how many rooftops in the area, or, population in any given, 3-5 mile radius? From a very simplistic angle, can you give us a high level point of view of those demographics?
Sure. I mean, the most important demographic that we look for is the amount of square footage of locker per capita, per capita. Mm-hmm. And so there's a metrics that if you're at 7 square feet of lockers per capita, that you're at across the country, the basic where demand equals supply. And so if you go above that metrics, you're expecting a slower lease up, you're expecting compression in your rental rates, all those sorts of things. So we always like to be well below 7 when we enter into a market. So the first 2 after that first one, so the first 3, we were really developing the model and testing it and making sure we understood what it was before we started, expanding at a faster pace. Mm-hmm. And so that was our beta testing period during that period of time. And that's where we saw that the household income wasn't as important, because we could alter the size of the lockers in terms of either making them bigger or smaller, depending on what the medium size income was. And also whether there's home or rental that impacted the medium income. So we have facilities that have 500,000 people within 3 miles that are 66% renters. And we have other locations where we have like 150,000 people within 3 miles, but the supply is incredibly low. Like there's only 2 other facilities within a 3 mile radius. And so we're not as concerned about if there's 500,000 people. We're more concerned of, how much other competition there is in the marketplace. So to me, the biggest factor in self-storage is not if the market is going up or down, but is how many other facilities are coming into my competition. So competition is the biggest, stress factor within our model.
Yeah, and how do you mitigate that risk? I mean, obviously you're working on these infill projects, like as you said, there's really, readaptive use. I mean, you guys are going after buildings that, obviously you're converting to self-storage. So there's not a lot of just raw land available for building new self-storage facilities, but I'm sure there's other vacant buildings, right? And so how do you guys mitigate that risk of, Public Storage or one of the other big developers coming into your space and, creating too much supply?
Well, we don't really have to do a whole lot to control that process because there's artificial barriers already in place. Mm-hmm. So some of those barriers, are there buildings that don't have or that have not been repurposed, so that are better situation for them. But then in combination with that, the zoning is actually another natural barrier. So when we were in Wisconsin, our project in Milwaukee, it was originally zoned storage. And so before we bought the property, we went in and got a certificate of occupancy for self-storage to make sure that we had the entitlements. After we closed, we got a notice from the city saying that our certificate had been revoked because they changed the definition from storage to self-storage. And therefore, since we were doing self-storage, we didn't meet the criteria. And so we had to go through the rezoning process to reclassify it from storage to self-storage, even though the building has always been storage. It was just storage for like on a large scale, like banker files and, ballot tickets and stuff like that. And so during that process, we really learned that, Milwaukee was trying to limit the amount of self-storage coming into the marketplace because they felt there was too much. But within where we were, our saturation level was under 2. So it was a very strong market for us. But the city was going to naturally limit any other competition coming in because they felt that there was too much of it already. Mm-hmm. So between having a large enough building and having a location that is not oversaturated and having the zoning, those 3 things sort of act as natural barriers for us that we don't really have to create any other barriers. So the thing that we do is we keep track of what is going on in the marketplace, and that's really a factor of when is the more appropriate time for us to reposition or sell the asset.
Got it. Other than the typical government interference during the entitlement process or rezoning process, what are some of the other factors that ultimately can pose challenges when you guys are considering an empty shell of a building to convert into a self-storage? Roofing, age, ceiling heights, all those kind of factors. Are there other very large ones that can be immediate deal killers?
Well, the efficiency of the space is the first one. So we're looking for a building that is as regular as possible. So you don't have any abnormal shapes or, configurations where it's just difficult to put lockers in, because the whole key to any building, whether you're in self-storage or, apartments or office, is your efficiency, your rentable square footage. So what is your net versus your gross? And the more space that you turn over to circulation, then obviously the less revenue that you can generate for your building. So when we were designing condominiums, apartment buildings, we would do it with a minimal amount of hallway space and stairs, just because then you can sell more of the building. Mm-hmm. The same is true for self-storage. So we want to make sure that we have a building that is easily accessible and easily, layout. So the ones that we just acquired are rectangular. I mean, they're very, simple structure and very, clean in that sense. The second one is the ceiling height. We looked at one building in Racine, Wisconsin. First floor was fantastic. They used to build stagecoaches in it, and it had 14-foot high ceilings. Mm-hmm. And then we got up on the second and third floor, and the ceiling heights were 7 feet. And it was, between the lockers needing to be 8 feet, and then you have to have sprinkler systems and ductwork. Yeah. We just couldn't make it work, and we just had. It was a great building. It was in an opportunity zone. The demographics were phenomenal. Everything was golden for us, except for the height of the building.
That's a bummer. Okay. How about the typical cost per foot for one of these conversions, in comparison to newly built, purpose-built self-storage facility?
Well, that's the whole key for us, because like the one we just bought in Dayton, we picked up that shell for $11 a square foot. Mm-hmm. We can't build a shell and a structure for $11 a square mm-hmm. foot. I mean, it's just well below replacement cost. So that's the first thing it's really attractive to us. So we're putting in around $30 to $35 a square foot on the construction side. And then obviously we have the land acquisition, but the land comes with the building. So when we compare our cost to a new construction facility, we're typically about 65 or 70% of what a new construction facility will cost. We looked at we were going to do a new construction in Arizona, and it was going to be a $12 million cost project. Our typical cost is between $6 and $7 million.
Wow. Fantastic. And how about parking issues? I mean, a lot of these older buildings, things that were like when we're talking about Chicagoland area, things that were built in like the early 1900s, back then there weren't a lot of automobiles, right? And so like a lot of these big buildings were built.
No automobiles.
What's that? Yeah, right. Well, that's true. Fair enough. So very, very little, if any, parking whatsoever. Does that become an issue as far as getting this, the rezoning put in place?
That's actually the easiest thing to address because of the fact that self-storage has, in terms of any use out there, has the lowest demand in terms of parking and foot traffic. Mm-hmm. A typical facility will only have like 4 to 6 people a day, which is a fraction of what it was going to be if it was apartments or retail or office or any other use. It's by far the lowest use. So we only need to have like 4 to 5, 6 parking spaces. I mean, for a 100,000 square foot facility, we'll have 1 to 2 people working there, and then people drive into our buildings. So, they might, if you're coming to check it out, you might need a parking space. Otherwise, if you're unloading, you're driving in, so you're parking inside the building.
Got it. Okay, fair enough. How about the financing for the, at least the types of projects that we're speaking of here, which are conversions, not built from the ground up or not acquiring an existing facility, but for these types of, I guess, more specialized conversions that you're doing on these older structures? What type of financing is available? I saw on your website that you made a mention that you did receive some tax credits as well as PACE funding, which I do not know what that is. So could you speak to the financing side of it?
Absolutely. I mean, the thing that we always look for is how to return our investors' equity back as soon as possible. That's our number one goal. And so we have done a lot of different things in order to accomplish that. We've sold off our cell towers. We have gotten historic tax credit. So the project in Milwaukee, we're getting over between, the final numbers haven't been finalized, but it's going to be between $1.3 and $1.6 million of historic tax credits. And then PACE financing is through the Department of Energy. It's the Property Assessed Clean Energy Act. And what it is any improvements that you do to make the building more efficient in terms of green, you can finance those improvements through this tax incentive program through the Department of Energy. And so what they do is, if we're doing a construction draw, those items would be paid through the PACE financing. And instead of having a traditional lender on it, it's applied to your real estate taxes. So they freeze your taxes, apply a special assessment on it, and it's amortized over the lifespan of the improvements. And so you're paying this above the line item in your NOI as opposed to below your NOI. Mm-hmm. And so it's considered an equity contribution versus a debt contribution because there is no lien, there is no mortgage. And so we can create a higher leverage for our investors because of the fact that we don't have to raise as much equity because the PACE is considered an equity component. And so when we refinance it, we can leave the PACE component in there, refinance out the debt, and then refinance out our investors' equity.
Huh. Very, very interesting. Okay. Very cool. I appreciate you explaining that for us. Let's talk about maybe some projects outside of what's the norm for you, which it seems, again, I've only seen what's on your website, and it seemed like a lot of older structures, but let's talk about readaptive use of, for example, I saw where I live over the last couple of years, public storage came in and took an old bowling alley. And they did add to it, but they used the existing structure that was there, did add, I don't know how many, maybe 10,000, 15,000 square feet. I've seen it done in different markets and, old grocery stores that went dark that were part of a anchored, retail shopping center. What are some of the other more common adaptive reuses as far as self-storage is concerned?
Well, we've looked at all of those. I mean, we have looked at old mall type structures. Mm-hmm. We actually made an offer on one, which was an old Lowe's. Lowe's had relocated and they had left their building behind. So we looked at that. We just couldn't come to terms with the dollar amount. We've also looked at a Menards. Menards is a more regional hardware store similar to a Home Depot or Lowe's, but more here in the Midwest. But we have looked at some grocery stores and other mall type facilities. But the challenge we had with those is the owners of the property had like a 10-year lease with a Fortune 500 company. And so they weren't willing to break the lease in order to sell it. They wanted to keep the income coming in. Mm-hmm. And with a triple net lease, it's just not doable. We can't make it work because of the fact that how much we would be paying on a yearly basis compared to what we could acquire the property for. So we will consider any of those type structures. It's just a matter of, one, is the owner willing to sell? And then two, what does the market look like and what is the demand? The Menards that we were considering, the saturation level was way too high. I mean, I just looked up and down the street and there was already a ton of self-storage around there. And most of the demographics were single family homes, but didn't have the population to support it. And square foot per capita was well over 7. So we just turned away from that market completely. And that's how we found the one in Milwaukee.
Is there data readily available that can be accessed for most MSAs throughout the country of square feet per capita?
I wouldn't say it's readily available. I mean, that's one of the things that we, as part of our due diligence, we spend our money on to make sure that we have that. And so,
use an outside firm for the feasibility study for the most part?
We always do. Yeah.
Okay.
We do outside firms because, one, the lenders always require that. They want to make sure that we're not just inflating our own numbers.
Sure.
We've had people come to us and say, hey, we want to partner with you on this self-storage facility. And, we'll say to them, well, let's see your feasibility report. And the response was, well, we've generated it ourselves. And to me, that's the first step in terms of the due diligence is, how can I trust your numbers? I mean, I could create, fantastic numbers for anything, but if I'm having third party verify these things, then that gives a lot more credibility in our mind. And so that's the thing that we come to expect. And now our investors come to expect it as well, because of the fact that we can go out and hire these services, and we won't go hard on a contract until we have that report.
Yeah. Got it. And what does a typical feasibility report run for one of your normal size projects?
Lots of money.
What, 25, 30,000?
No, it's not that much, but it is a good amount of money. And it also depends on if they've been there or, if they need to come out and we have to pay for them to come out and actually see this facility and stuff.
Sure. Got it. Okay. I got lots of other questions, but I want to make sure that we're not missing anything that's integral for folks that are listening in that have an interest in this side of the business. Is there anything that we missed that comes to mind to you that you think is incredibly important for folks to know? And again, speaking to the adaptive reuse of these older buildings, right? I mean, self-storage, not building ground up, not buying existing, but actually taking an old structure and converting. Is there anything, big that we've missed that we haven't discussed?
Well, one of the things that is just brand new within the last year is the whole opportunity fund and the opportunity zone. So that is something that we've done on the last 2 projects. And I was just recently asked to speak at a conference in Las Vegas about this. And the guy who actually created the whole concept of the opportunity zones under the Obama administration, his name's Glickman. He asked everybody in the audience how many people have actually were doing this. And I can confidently say I was probably less than 10 people that had raised their hand in terms of being able to say that they're doing this. But he described this as the most powerful tool in the tax code to date. And the thing about it is people think it's in bad neighborhoods. Well, it's not. It's in neighborhoods where they're trying to encourage economic development. Mm-hmm. And that's the thing about it is that the 2 that we have bought are both in downtown, mid-market communities that are on the uprise. And so for us, it's extra gravy for our investors. We don't model our rate of returns on it. We don't, first find the opportunity zone and then the property. We always look at the property, and if it's in a zone, then it's a bonus.
Got it.
So, if we're looking for those sort of opportunities and our replacement cost is so low that it's, it makes it that much more sustainable, because if we can buy and build below what our competition is, then we have a competitive advantage in terms of what we have to charge in order to get people into the door. And so that is the thing that we're always monitoring. We've had brokers come to us and say, well, it's a great deal at $40 a square foot. And my response is, well, my competition bought it for $30 a square foot. So they have a $10 a square foot advantage over me right off the bat. I need to be below that. And so we passed on buildings where we knew what our competition bought it for. And so that because we wanted to make sure that we were competitive in the marketplace. Got
it. Now that makes sense. As far as like the minimum size of a project where scales of economy are achieved, I mean, as far as net rentable square footage, I mean, what does that look like? Or at least what's your standard?
Our standard is what the REIT standard is. They're looking between 80 and 110,000 square feet. So for a Class A facility, that's how big they want. So people have approached us about a 40,000 square foot, and the economics make it tougher because of your overhead. So if I have to put in an elevator and I can spread that over 700 units versus 400 units, then it just makes it that much more feasible. So we're looking for the larger type facilities, which we can easily flip to the REITs.
Yeah.
If we're below that level, then we're looking at really mom and pop type operators that are going to be operating one-offs.
Mm-hmm. Okay. And what's the long-term strategy? You just mentioned flipping the REITs at some point in time. Is that ultimately the plan with everything you have, or are you guys longer-term investors?
My nugget is really that the best time to sell is when you don't have to.
Absolutely.
And so if we can hold these and get them as best stabilized as possible and create a package of these to put together in the marketplace, then we will get the best rate of return. And in the meantime, if they cash flow and we can refinance out in our investors' equity, then it's even better. And so, we don't want to be under the pressure of having to sell. And so we have a goal of 3 to 5 years when we think these things will perform. But if it's the type of thing that we have to hold, then we're not afraid to hold them.
Is there an opportunity to take anything like an older multi-level parking garage or something similar to that and convert to self-storage? Is that just too far out of the realm of possibility?
Well, we have been asked to do that. We were just recently approached about a facility in Ohio about that. And the challenge that we saw with that was that, again, it goes back to circulation. So when you're dealing with cars in a parking garage, your plates are not level, because you're either having to move people up or down. And so you lose a lot in circulation because, you can't be over 10% slope for cars in terms of safety. And so there's a lot of loss in terms of your circulation because of ramps. And so that was one of the biggest challenges that we saw. It was like a 40,000 square foot parking garage. And then when you take out all the ramps, you're just that much further down. And then it had an old elevator, which wasn't sized properly. And we need a bigger one in order to get, a king size mattress into it. I mean, if we're going to put it down to simple terms, that's what the elevator's got to be able to hold a king size mattress. So the combination of those factors just made the parking structure a little too complex.
Got it. It sounds like you guys are spread out. You've got projects in many different markets. I mean, do you have a science of how you go through each of these individual markets and identify potential candidates, and then ultimately what the next step looks like after that? Is it just looking for buildings that are already for sale, or do you guys aggressively kind of hone in on an area and then reach out to every prospective property owner that has a building of the size that might meet your criteria?
Great question. So if we look at the country as a whole, and the East Coast and then through the South and then the West Coast, that demographic is heavily saturated with self-storage already. So those are markets that we're not necessarily avoiding, but we're not actively pursuing, because if, when someone's come to me and said, hey, I got a site in Florida, I got a site in Texas, 90% of the time, if I drop that address into Google Maps and then do self-storage near there, and the page is like flashing red dots everywhere, then I know that the saturation is too high, right? And so that's about a 5-second litmus test for me in terms of like where we stand within the marketplace. So that's why we're going after the Midwest. We're going after more centralized locations in there that are underdeveloped, underpurposed. And so that's why we're in Wisconsin, Illinois, and Ohio. Right now, we're not as keen on Illinois based upon the pensions and the tax issues that are going on there. So we're looking at other markets that have more stabilized and more easily projected modeling there. So we are looking throughout the Midwest, and we are going after those areas. Now, we work hand in hand with our feasibility consultants because of the fact that they have a pulse across the country.
Yeah.
And so that's how we found Toledo. One of our PACE operators said, hey, would you ever consider this in Toledo? And we called up our feasibility consultant and said, what do you think about Toledo? And they did some preliminary market analysis, and they said the rental rates are phenomenal. And so that's when we began asking our agents to find buildings in Toledo to accommodate them. So it's that sort of working process.
Well, good deal. This has been a lot of fun, Scott. Very informative. Again, is there anything else that we might have missed that could be relevant for our listeners to know regarding, again, readaptive use of older buildings into self-storage? I think we've covered a great amount of ground, and I've got all the questions answered that come to mind. But again, there's a good chance I might be missing something. I think we've covered it all, but I'll leave it to you to tell me if that be the case or not.
It's the type of thing that, it's not on the forefront of anyone's mind, but then once you start looking for it, you realize how prevalent they are. So when a lot of people tell me like, hey, I'd love to do self-storage, I can't think of anything in my neighborhood, and I'll drop in an address. And then I'm like, well, there's this one. They're like, oh yeah, there is. And it's the type of thing that everyone overlooks, but people don't realize how much it's really utilized, not just in the residential community, but also in the commercial community. So there is a benefit to the community to take an older building. Like for instance, the one we're doing in Chicago, it's the old Lincoln Log factory. And the population is so dense. We have 500,000 people within 3 miles. 66% of them are renters. And parking's a huge issue. And the alderman was never going to allow apartments in there because of the parking and how dense everything was. So it became like the flash mob party building because it was sitting vacant. But here we could come in, clean it up, repurpose it, bring in business into the community, provide a service, and maintain an older building that really has a lot of historic significance to the city of Chicago and the community. I mean, everybody knows Lincoln Logs. And so we're actually going to paint, the old Lincoln Log branding and logo onto the side of the building.
Oh, that's pretty cool. I like that. I was going to ask you about the exterior. I mean, when you go into historical buildings like that, has it proven challenging dealing with the, if there's any historical society that's kind of overseeing the renovation of the structure?
Not on that one. The one we're doing in Wisconsin where we're getting the historic tax credits, I mean, they are looking at every aspect of the building. And typically the exterior is where you have the most historical significance because the rest of the building's warehouses. I mean, the lobby was done very ornately. So we have to maintain that. We have to keep lockers a certain distance away from the windows and those sorts of things. But the other buildings, like even the Lincoln Log factory, it's just a warehouse. So this historical significance is the fact of the use, not the architectural design of it.
Got it. Well,
so we're doing a similar building in Dayton, and it's just a brick building with glass windows, and it's a square building. So awesome. There's not much we could do with that.
Awesome. Well, this has been exciting, Scott. I wish you guys the best as you continue on this journey. It sounds like you're making a lot of progress and have a lot of fun and interesting projects in the works. And it sounds like there's never a dull moment, during your business day.
No, it keeps us on our toes.
Yeah. Well, fantastic. Well, I'd like to enter into what I call the Golden Nugget segment of the show. And this is where we're going to work to wrap things up. And again, you left us with a ton of golden nuggets already. But if you had just one final one left, hiding somewhere in one of your pockets, one final golden nugget of advice or wisdom that you can leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Well, I've been through a couple cycles now. It's in 25 years into this industry, 20 of owning my own business. And so I've been through 3 market cycles. And I think that if I were to say to, someone who is starting off or going through it or has not experienced the full market cycle, is that the evaluation of risk is so important in understanding the market forces. And I think a lot of people underappreciate how important understanding risk is. And my mentor, who's Dr. Nito Kubain, a wonderful man, always said it to me this way. He said, think of it in best case scenario, worst case scenario, and what most likely will happen. Yeah. And if you can live with what most likely will happen, then go forward. And if you get the best case, great. And if it's worst case, then at least you can move on and, you're not too badly off. But I think a lot of people intertwine best case with what most likely will happen. And so when worst case becomes, most likely will happen, or even you're further down the track and the worst case is really, really bad, that's when people get wiped out. And that's what we saw in 08, 09, is that people weren't assessing the level of risk. And right now I'm seeing that level of risk, not to the same degree as 08, 09, but I'm seeing a lot of risk in a lot of centralized or specific communities across the country where I think people are over inflating the potential value of properties in order to get deals done. Yep. And I think in certain marketplaces like multifamily, I think the cap rates on multifamily are historic lows and people are buying aggressively. And to me, I just don't see where you can take that marketplace. I think there's going to become a correction in that.
Yeah, no, I believe that as well. And I'm assuming you guys are not buying any multifamily to date. I know that you said you bought a lot during the 9, 10, 11 era. Is that not a asset class that you're currently involved in today?
I sold it all. I don't own any more apartments. I saw the caps at being an all-time low, and I'm like, this is the time to get out. So did we have to sell? No, but we chose to sell.
Mm-hmm. Fantastic. No, absolutely awesome. Scott, again, really appreciate your time and joining us here on the show. And folks, if you'd like to learn more about Scott and the different projects he's involved in, you can go visit his website, and that's CodaMG.com. And that's Coda, CODA mg.com. And Scott, thank you again. Been an absolute pleasure. Would love to follow your progress and hopefully maybe even have on a future episode and revisit some of the projects you're currently in the works on. And again, it's just a very interesting niche that you're in, not self-storage per se, but ultimately how you're arriving at that finished product, right? Taking something that was, a Lincoln Log factory, I don't know when Lincoln Logs originated, but probably 70, 80 years ago, maybe longer than that, I'm not sure, and turning it into a self-storage facility. I think that's quite awesome. And obviously a very lucrative business as well. And again, very interesting to say the least. So every day is a new one for you. And again, really appreciate you coming on the show and wish you all the best.
Thank you very much. I appreciate it.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.